guys, welcome back. In today's video, we are talking about why AMC is a winning pick, shorts being investigated, the new leverage limits, and many more in this video. Firstly, we're taking a look at this. All those articles downgrading AMC theaters reminds me of May 2024 when they dropped the same articles for GameStop. Now, something that we've obviously always seen is these articles on AMC. And again, GameStop as well. Now, we all know that they do it with the intent of course, giving the incentive of people to sell their AMC shares or for anyone to obviously stay away from AMC and GME. Now, the whole reasoning behind that is because they firstly want the real shares, they want retail investors to get out, and secondly, they want to get rid of any buy pressure there is for AMC. That's something we always know, because one of the biggest factors they use to remove buy pressure has always been dark pool. But despite that, despite how they're routing 60-70% of the orders away, we're still getting massive buy pressure, and that just showcases how strong the investor base is. But obviously what they fail to mention with these articles are, of course, all the manipulation that is happening, but also when you can see here, on Feb 14, 2025, a new Schedule 13GA was filed with the SEC between AMC and Discovery Capital Management. When someone with a winning stock picking record for 25 years, like billionaire Robert, buys into AMC, take notice. So this is what we're saying. Now, before we even go further into this, we have to understand is that these articles never mention the fact that institutions are buying in, that large institutions understands the potential of AMC. They always focuses on whatever little details they can get. And so this is what we talked about. Firms who are out here to obviously make money, who have been shown in terms of how strong their picks have been buying into AMC. And this is what we are seeing. But this isn't what articles are mentioning. You can also see, for context, Discovery Management is a AMC creditor holding exchangeable notes that are convertible into AMC common stock. They can convert 38 million shares worth of debt into AMC stock under the term, and Citadel personally bought 126k shares in Feb of 2025. So we've talked about how firms who are willing to obviously make these agreements that, the debt can be converted into notes. And what that means. Firstly, we talked about how that shows their confidence in AMC. If you thought AMC was going to be a bankrupt company and that their shares were going to be going to zero, then you will only ask for cash back. And in fact, in the first place, you wouldn't even be lending them money. And so the fact that not only are they willing to lend them money, but that they are also willing to convert it into shares showcases obviously their confidence in AMC. And so this is what we talked about with the difference of news and the difference of institutions. News are telling you that no one should be buying AMC. But what the institutions are showing is that they are buying AMC any chance they can get. And they're doing actually every sort of method to get these AMC shares, like we've seen here, with the fact that they're obviously making sure that they can convert the shares worth of debt into, of course, AMC stocks. And so this is what news articles aren't mentioning. You're not seeing news articles showing that institutions are confident in AMC. What you'll always see is talking about how, people should sell your AMC shares, that AMC is going to go bankrupt. And these are the only news that you will see. So the very fact they are still doing this obviously lets us believe and understand that AMC is a strong company, that these shorts are stuck and that they are worried they can't get out, hence why they need to make these articles. And so we've obviously always known that, and we're just getting more confirmation every single day. But furthermore, you can also see here, gaslight much. Do you know how precious AMC shares are? Pre-forward split price on August 22nd, 2022 was 113 to 130. We did a 10-to-1 reverse split August 23rd of 2023. The algo stole half the share value when Ape and AMC rejoined. The algos actually moved AMC's price down to Ape. That's impossible. So this is obviously, a bit of history, and it's for when Ape shares were obviously released. And we talked about how they should have been the same value. And one of the biggest things for why shorts needed to bring it down was just because of the damaging effects it had for them. Remember, anyone who was short one share of AMC, when ape shares were released, they were short both one share of AMC and ape shares as well. So instantly they took a massive hit because it meant their short positions doubled, it meant that their synthetics positions doubled, and that they need to double down. Hence why they needed to manipulate AMC and ape. And that's what was shown. We knew with the case of the ape FTDs that there were in fact, hundreds of millions of shares out there. The fact they didn't even settle it properly, the fact that it was suddenly one day just removed off of the threshold list also gave us an understanding of what was going on. But when we go further into that, it then highlights the true value of AMC shares. It's shown us what real price of AMC should have been. And again, this is only based on the fact of what we have before. I've always said this in terms of understanding if we did get real price discovery for AMC, the price would be much higher. The reason for that was because there will be a lot more other factors involved, such as market sentiment, such as FOMO, and the fact that when people see the real price of AMC, there are more people who are going to be willing to invest, and that's of course going to bring the price up even higher. And so that's the damaging effect that these shorts have of course done. And this isn't just me saying it, because we are actually seeing regulators actually talking about this. You can see breaking subpoenas ordered to hedge fund brokers and regulators for potential market manipulation, naked shorting, trading data, and more. So this is just a list of who the subpoenas have been ordered to. So let's go into a bit in depth into this. Yesterday we covered an article about how a company that was worth $1 billion because of naked shorting actually reduced it to just $10 million. You can see how damaging that effect is. And finally, and potentially, we are going to be seeing, firms actually being cracked down on what they are doing. You can even see Citadel officially served and subpoenaed, signed by judge. So the subpoena and examination order are part of the trustees' effort to uncover whether Citadel Securities engaged in market manipulation and naked short selling. Now, from data, we already know what the answer is. And so hopefully, they are able to see these part of the data and obviously use it for this particular case. But when we pinpoint it and when we kind of look at some other factors, you can see, what these firms are doing to manipulate shares for their own benefits. You can see settle the trades and then tell us what the numbers are. Citadel Securities reported its largest ever trading haul, surpassing the tally at some of Europe's biggest banks to cement itself among the world's trading behemoth. So their full-year trading revenue rose 55% to $9.7 billion from the previous year, according to people familiar with the matter who asked not to be identified, discussing private information. That topped the previous record of $7.5 billion set in 2022. So what we're seeing is that allegedly they're making, record revenues. And now when your revenue increases, obviously your profits are increasing as well. But what they're not saying is, just like we highlighted here, settle the trades and then tell us what the numbers are. Because we've known they've manipulated, and at least they're being investigated for market manipulation and naked short selling. So this is what they're doing. They're damaging retail investors for the sake of their own gain. So as opposed to saying that the revenue rose 55% to 9.7 billion from potentially their own skills, from potentially increasing, their infrastructures to obviously benefit not only themselves, but the market, actually it's them increasing their ways of manipulation to then, harm and hurt the retail investors to get their money to them. And so that's where the 55% comes from. But even then, is this actually real? Because trades aren't settled. We've seen this what banks do, and this is likely what they are doing. And this is obviously worrying because this is what they have been doing. And not only that, we talked about how they needed to raise money to pay back their investors. So if they were supposedly meant to be making, record revenues, if they're making, a large amount of profit, why do they still need to raise money? And so that's the first problem. The second thing is, potentially it's got to do with this. Hedge funds are panicking over new leverage limits and reporting requirements proposed by the Financial Stability Board. So regulators are finally wanting to restrict hedge funds' use of borrowing to finance these dangerous trades. Hedge funds have been using leverage to boost returns, and regulators are starting to grow weary over the dangerous practice. And so one thing we've known is the only way these firms are able to make these massive amounts of profit is because they're using large leverage. And now these leverage are getting to a point where they're extremely ridiculous because they're not leveraging, $1 million, $10 million, but they're leveraging in the hundreds of billions of dollars. And for some big banks out there, trillions of dollars. And so that's the money that's obviously involved. And now we talked about this. If they need to raise money to pay back their investors when they've made a large amount of profit, is it because they're worried about the new leverage limit and therefore they need to keep a large amount? But then it goes down even further. If they needed to keep a large amount of capital to meet the new leverage requirements, doesn't that just mean that they are extremely over leveraged and that they are worried? And so when we get into all of that, we understand why they need to constantly suppress AMC and GME. And you guys, thanks for watching the video. I'll catch you guys next time.